Welcome to the deep dive. Today we're really zooming in, putting our magnifying glass on probably the single most vital company in global tech, TSMC.
That's right. The world's biggest dedicated semiconductor foundry.
Exactly. And if you want to understand, where AI is going or when new phones might launch, even just the health of the whole digital economy, you really have to look right here. We've gone through their, pretty dense Q3 2025 earnings reports, the conference call data, and we're going to pull out the really crucial stuff for you.
Yeah, this is essential because, look, TSMC isn't just making chips. They're enabling basically every major tech player you can think of.
From the hyperscalers building out AI?
To the big smartphone companies, yeah. Their performance. It's like the definitive pulse check on tech demand.
Yeah, it's easy.
Like speeding up, slowing down, changing direction.
And this quarter's results are key, aren't they? They send signals way out into 2026.
Definitely.
Okay, so let's anchor this with the headline numbers, and they are, frankly, staggering. Revenue for Q3 2025 hit $33.1 billion US.
$33 billion.
That's a massive jump, right? A 40.8% increase compared to the same time last year.
Huge year-over-year growth.
And net income followed suit, pretty much. Up 39.1% year over year. That gives you diluted earnings per share of NT $17.44.
40% growth. I mean, that's just spectacular at their scale. It really shows how intense the global demand for advanced computing is right now.
It really does. But here's the first, important financial detail you need to get. They're a global giant, obviously, but they report locally in new Taiwan dollars, NTD.
Ah, right. And that conversion actually gives us our first little nugget of insight, doesn't it?
It does.
Because if U.S. dollar revenue grew over 40%, how come the revenue growth in NT dollars was quite a bit lower, 30.3% year over year?
Yeah, it's a good catch. It's simply the currency exchange rates working against them a bit this time. Kind of a headwind.
Okay.
So when they sell chips internationally, mostly in U.S. dollars, and then convert that money back into NT dollars for their official books, well, if the exchange rate isn't favorable, it drags down the growth figure reported in NTD.
The average exchange rate moved about 7.5% unfavorably for them year over year. So basically, the U.S. dollars they earned bought slightly fewer NT dollars compared to last year.
It's a great illustration, though. Even a company dominating at the nanoscale, they still have to deal with global macro factors like exchange rates.
Absolutely. It affects the bottom line reporting.
Okay, so economic headwinds aside, let's look at the engine driving all this. The technology itself. I mean, TSMC means cutting-edge manufacturing, shrinking those chip features. Where's the revenue actually coming from, technologically speaking?
Well, the story hasn't really changed much there. It's all about performance, pushing everything to the absolute edge.
Right.
TSMC calls its advanced technologies anything that's 7 nanometer or smaller. And these advanced nodes, together, account for 74% of their total wafer revenue in Q3.
Wow, 74%. That's a huge concentration in high tech. Really confirms their leadership position, doesn't it?
It really does. They're not primarily a legacy chip maker. They're focused on the leading edge.
So let's break down that 74%. Which specific nodes are bringing in the most cash right now?
Okay, so the breakdown really shows the market's hunger for power efficiency and performance. The established leading node, 5 nanometer, that was the single biggest chunk at 37% of wafer revenue.
37% from 5 millimeter. Okay. Then right behind it, the node that's really hitting its stride now, 3 nanometer, that contributed 23%. 23 from 3 nanometer already.
Yeah. And then you've got 7 nanometer still pulling a respectable 14%.
That rapid scaling of 3 nanometer, that seems really significant. If you look back just a year ago, Q3 2024, 3 nanometer was, 20%?
That's right, 20%.
And 5 millimeter was 32%. Now it's 37% for 5 millimeter and 23% for 3 nanometers. That's a really fast migration, isn't it?
It's ferocious. It shows they're successfully pushing their customers onto the newest, most expensive, densest nodes they offer.
And customers are clearly willing to pay that premium.
They are. It just demonstrates the velocity of this industry, the complexity and the cost of manufacturing at 3 nanometer. It's exponentially higher than even 5 millimeter or 7 millimeter.
Could you maybe help us visualize that? Why is moving from, say, 5 millimeter to 3 millimeter just so much more profitable for TSMC, but also just incredibly expensive to build the factories for?
Sure. Think of it like building a city, but hyper-precise, where the streets and buildings are getting unimaginably smaller with each generation.
Okay.
To even draw these tiny features, TSMC depends heavily on something called extreme ultraviolet lithography EUV machines. These things are enormous, incredibly complex.
And ridiculously expensive, right?
Hundreds of millions of dollars each. The capital needed just to buy, install, and run one EUV machine capable of printing 3-nanometer features is astronomical.
Wow.
So the high profitability on these advanced nodes is almost required because the investment, the sunk cost in the machinery, the clean room facility, the R&D, it's just immense. The market is essentially paying for access to that unique cutting-edge precision.
That makes sense. Okay, so we know the tech is super advanced. Now, who's actually buying all this? Who are the customers driving this $33 billion quarter? If we look at the revenue split by platform, what does that landscape look like?
Well, high-performance computing, or HPC, that remains the absolute bedrock of TSMC's business.
Still number one.
Still number one by a good margin. It accounted for 57% of net revenue in Q3. This covers chips for, data centers, AI accelerators, high-end server CPUs, all that heavy iron.
Okay, 57% for HPC. And the second biggest?
Smartphone. That's the critical second pillar, bringing in 30% of revenue.
Right. And then the rest is smaller slices. Automotive and IoT are both around 5%. Digital consumer electronics, DCE, is just 1%. And then others make up the last 2%. HPC at 57%. I mean, that feels right in this era of AI, everything. But here's the thing that kind of made me pause when I read the report. When you look at the sequential growth quarter over quarter, where did the surge actually come from in Q3?
Yeah, this is where it gets really interesting. The growth didn't come from that biggest pillar, HPC.
Really?
HPC revenue was actually flat sequentially. 0% increase from Q2 to Q3.
Hold on, flat. If the whole world is shouting about AI and building out data centers like crazy, how is TSMC's biggest segment, HPC, completely flat quarter over quarter?
That's the million-dollar question, isn't it?
Does that mean saturation? Or maybe just like inventory digestion after a huge run-up earlier in the year?
It's likely a mix of things. Could be some inventory normalization after, a period of really explosive demand. Plus, these huge AI chip orders, they tend to be lumpy.
Right, not smooth quarter to quarter.
Exactly. Maybe deliveries were super heavy in Q2, or perhaps the next big ramp up is slated for Q4. The fact that HPC was flat and not down still shows massive underlying demand is there, but the growth engine for Q3 specifically, that was definitely somewhere else.
Okay, so if the main pillar was static, which sectors gave them that sharp, concentrated burst in Q3?
Well, the more cyclical segments really stepped up big time. It looks like the classic Q3 restocking ahead of the holidays and, major new product launches.
Oh, the seasonal effect.
Yep. Smartphone revenue jumped 19% sequentially. IoT wasn't far behind, up 20% sequentially. And automotive, which just keeps being this surprisingly strong growth area for them, that increased by 18%.
Wow. So those three, smartphone, IoT, auto, they provided that sharp growth that made the overall quarter look so strong. They completely offset the flat HPC number.
Pretty much. It was that seasonal cyclical surge that really delivered the momentum in Q3.
Interesting. And on the flip side, we did see one area show some real weakness. Digital consumer electronics, DCE, that dropped significantly, down 20% quarter over quarter, 20% decline. Ouch.
Yeah, suggests some specific softness there. Maybe lower consumer demand or perhaps delayed product cycles for things like, certain game consoles or home entertainment gadgets.
And we can't skip over the geographic concentration of their sales. That's a huge strategic point for the whole global supply chain.
It really is. The reliance is intense. North America accounted for a massive 76% of their total net revenue in Q3.
76%.
And that's actually up slightly from 75% the quarter before. It just highlights the incredible strategic importance of U.S.-based chip designers, many of whom are the ones pushing for those cutting-edge 3-nanometer and 5-millimeter nodes. Okay, let's switch gears a bit now to the money machine itself. Financial health, investment velocity. Margins are so critical in this kind of capital-heavy business, right? Because you need that cash flow to build the next generation of fabs. How did profitability look this quarter? Well, their margin performance is still absolutely top tier. It really shows their market power. Gross margin rose to 59.5% in the quarter.
59.5. That's up almost a full percentage point from Q2.
Yep. And operating margin also ticked up, hitting 50.6%. Maintaining margins that high requires incredible discipline and scale.
To keep gross margin near 60% in such a competitive field is kind of unheard of, isn't it? They mentioned high capacity utilization and cost improvements were the drivers. That high utilization must be key.
Oh, absolutely. Think about the fixed costs of running one of these giant modern fabs, the clean rooms, the expert staff, those multi-million-dollar machines we talked about.
Yeah.
The costs are astronomical.
Right.
So running those fabs at high utilization means you're spreading those massive fixed costs over a huge volume of wafers. That maximizes the profit you get from every single piece of equipment.
But they also mentioned a couple of headwinds that kind of held the margins back slightly, even with those gains. Besides the unfavorable exchange rate we discussed, what was that second factor? Something about dilution coming from overseas fabs.
Yeah, that's an important point for their long-term strategy. TSMC is expanding geographically, building new fabs outside Taiwan, in Japan, the US, potentially Europe.
For supply chain resilience, political reasons?
Exactly. Critical strategic moves. However, these brand new fabs, especially when they're just ramping up or operating in a new country, they aren't immediately at peak efficiency or cost control like the established fabs in Taiwan.
Ah, okay. They have higher startup costs.
Right, higher initial operating costs. So temporarily, they slightly drag down the overall company-wide profitability figure. It's a necessary trade-off for the long game strategically, but it does put a bit of immediate pressure on those amazing margins.
So basically, sacrifice a tiny bit of margin now for that geopolitical safety and strategic access later. Makes sense. And that brings us right to the investment demands. We see these incredible margins, but how much of that cash just gets funneled straight back into building the next thing?
A truly staggering amount. Those high profits are basically a survival mechanism in this business. Capital expenditures, CapEx, for Q3 alone totaled US $9.70 billion.
Nearly $10 billion.
In one quarter.
In one quarter, yeah. And this is why connecting profitability to cash flow is so important. Their free cash flow, FCF, actually decreased sequentially. It fell to NT $139.38 billion, down quite a bit from about NT $200 billion in Q2.
So wait, even though profits were huge, their free cash flow went down because they had to immediately pour so much of that incoming cash into buying machines, equipment, building new capacity. That's exactly it. The drop in FCF isn't a sign of financial weakness at all. It's a sign of immense investment velocity.
Okay.
They are on this brutal technological treadmill. They have to spend billions every single quarter just to stay ahead, just to keep developing the next node.
It's relentless.
It is. But despite that massive spending, their overall financial stability is still rock solid. Their net cash reserves actually increased by about NT $100 billion in the quarter, reaching over NT $1.75 trillion.
Wow. And even the efficiency metrics, things like inventory, they look better too.
Yeah, small improvement, but still positive. Days of inventory decreased by 2 days down to 74 days, suggests they're moving product efficiently through the supply chain. Okay, so let's wrap this up. What's the big takeaway for you, the listener, from this deep dive?
I think it's pretty clear. TSMC is seeing enormous overall growth, really cemented by that relentless migration to 3nm and 5mm chips. And while their biggest segment, HPC, was intriguingly flat this quarter, something to watch, the really spectacular Q3 performance was powered by that strong seasonal sequential surge from the smartphone, IoT, and automotive sectors.
Yeah, and the financials just showcase TSMC's mastery of this incredibly capital-intensive business, being able to sustain gross margins near 60%, which is phenomenal even while you're deploying almost $10 billion in CapEx in a single quarter. That's the core.
High profit, immediately reinvested.
That's the game. All right, so here's a final provocative thought for you to chew on after this deep dive. The reports confirm that 76% of TSMC's total net revenue comes from North American customers. 76%. That is a huge strategic and economic concentration. It really is.
So what happens? What happens to the economics to global tech supply chain reliability if that customer concentration starts to shift? Or what if advanced chip manufacturing capabilities genuinely succeed in spreading out more across different continents? That intense reliance on one primary customer region, that feels like the critical variable to watch going forward.
The nanoscale economy might be global, but its customer base, for now, is still highly centralized. Well, thank you for joining us.
We'll catch you on the next deep dive.